You're welcome to our technical analysis video. I will try and as much as possible to make it very brief and straight to the point. Please go back and do your studies, and please take Baby Pips seriously, babypips.com seriously, read it through. Some of these things will become clearer when you mix it up with Baby Pips. All right, so let's get to the video. Technical analysis. Like I told us from the previous video, that we use price data to determine the direction of the market. And this kind of analysis is predicated upon the fact that history always repeats itself. All right, so we are riding on this concept to predict the future direction of price. So what price has done before is what we will seek for it to happen again. Then we analyze based on this fact and get our direction. All right. So technical analysis is the use of price data to predict future price movement. It is built on the saying that history will always repeat itself, and like you know, history will always repeat itself, which is true. And over the years, price has printed a lot of patterns repeatedly, and when we see these patterns being repeated in the future, we can decide the direction of the market based on the direction of the previous occurrences. So for example, now, maybe in the previous times, price came to a particular level, printed something like W here. Are you getting it? Once it printed like W, and technical analysts will take note of something, they took note of something like this. Then 5 years, 2 years later, it repeated it. 1 week later, it repeated it. And when they repeated it, it went straight up like this. Are you getting it? So what technical analysis is telling us, since we have known that price will always come here, do a W pattern and go like this over the years. It has happened twice, 3, 4, 5 times. So a technical analyst now take note of this particular pattern that repeats itself. Then when you're analyzing today, you now see the same pattern repeat itself like this. What will you now do? You can now predict based on this past data that this market will go like this. That is just the simple summary of technical analysis. All right. So we are using past data to predict future price movement. All right. Now, we have majorly 4 pillars of technical analysis. We have the candlesticks, we have the indicators, we have the structure, we have the trend. We have a lot of tools that we use. We have price patterns too, which if I am to include, I can include in number 6, right? Price patterns. But we are not going to be using that in this course, so I didn't include it. There are a lot of things we are not going to be using here, so I didn't include them majorly. All right, I just included what we will be using. All right, so we'll be using candlesticks, we'll be using structure, we'll be using trend. All right, we will not be using price pattern, and we will not be using indicators. I just include them for knowledge purpose. All right, so I'm going to be taking each and every one of these things and explain them for you in details. But this is the 3 price pillars. There are a lot of things about technical, a lot. All right, I'm just trying to pick the things that are related to this course so that it will be easier for you. All right, when you read more personally, you will get more details on it. All right, so let's go to candlesticks. Okay, indicators first. Now, in forex, we use indicators. Are you getting it? And indicators, forex indicators are tools used by forex trader to interpret the market data provided by the candlestick. It provides insight into the strength and direction of the market. Examples of indicators are RSI, moving average, oscillators, indicators. We have majorly 2 categories of indicators. We have leading and lagging indicators. They have nothing to do with what we want to do today, so you don't need them. So let's go to the one that matters to us in this class. All right, candlesticks. Now, candlesticks, we use candlesticks to represent price on our charts. Like those of you that have downloaded MT4 already, you will see that candlestick is represented on our charts. We have candlesticks on our chart, and the reason is because it represents price, the movement of price over a specific period of time. Depending on the time frame you put it, either 5 minutes, 1 hour, 4 hours, it represents price, the movement of price. It started from a Japanese rice seller who was using candlestick to track the movement of price of rice. All right, so when forex traders saw that it's a very important tool in trading and can be used for forex trading, it was adopted into the system of analysis. All right. So we use candlesticks to track the movement of price over a period of time. Candlesticks give us details of the movement of a currency. Candlesticks can either be bearish or bullish. Now, if you check this graph, you see the green candle and the red candle. All right. The red candle represent the bearish candle, means the sellers are in charge. All right, it means people that want to push the markets downwards were in charge. If this candle is for 5 minutes, it means in 5 minutes the sellers were in charge. Now, bullish candle again shows the buying pressure. It's showing you that in that 5 minutes, buyers were in charge. All right, so you can have candlestick for 1 minute, 5 minutes, 15 minutes, 1 hour, 4 hours, etc., etc. Is all in your MT5 there. All right. Now, so to understand candlestick proper, we have four major aspects of a candlestick. We have the open, the close, the high, and the low. All right, sorry, six. We have the upper shadow and the lower shadow. I'll try as much as possible, and we have the real body. All right, I'll try as much as possible to just explain a little bit to us. You can go and do your study. For example, the open is always where the price opened, where the price started, printed from, where it started from. All right, the open is where the price started from. All right, and the close is where the price closed. All right, now listen to me, listen carefully. If the close is above the open, the candle will be green. All right, but if the close is below the open, the way you see here, the close is here, the candle will be red. So when you are entering the market, you don't know if a candle will be red or blue or green. What you just know is that if until the market has closed, you cannot say this market will be bearish or bullish. Are you getting it now? It depending on the close and the open. All right. Now, and this down is called the shadow. The shadow, because sellers try to push this market down. Are you getting it? It shows the victory in a bullish market. It shows the victory of the buyers over the sellers. Sellers tried to take over the market after it opened here to push it down, but the buyers came in and won over them and pushed it up. And even while buyers pushed it up to this place, seller pushed it down to this place before they close it here. They closed it here. So a candlestick represents the battle between the buyers and the sellers to take over the market. So, and the body shows the dominant power of either the seller or the buyer. For example, here now shows that buyers were completely in charge here. Sellers were completely in charge here. There was no battle between them in this place. All right. So it applies for both candle. This is how it majorly works. Please go and read up about candlesticks. I will not be able to. So this is I will not be able to go more in details. But once you read your baby pips, you get more knowledge on how it works. Once you go to your child, you'll be seeing red candle, green candle, red candle, green candle, showing you that in the past 5 minutes, this is what happened. In the next 10 minutes, this is what happened. There was a battle. Sellers push it here, they push it back. Then you now form a shadow. But if they took over, if the buyers took over, you see a body, you will close above it. If you close below it, it will become a red candle. That's how it works. All right, so we use these printings on the chart to predict market direction. So the next thing you need to take note of is market structure. All right, market structure is the way the movement, the market structure is the way the moves and the repetitive structural flow of the market. Market have a specific repetitive structural flow. Now, and this structural flow is called the market moves in higher highs, all right, and higher lows in an uptrend. All right, and the market moves in lower highs and lower lows in a downtrend. All right, I know you might not understand it, but I will explain it in the next. I will explain what it means in the next graph. All right, structure example, higher highs and higher lows example. If you say higher highs, when we say higher highs, we means market moves like this, like this, like this in a waves. And one is moving in a waves like this. If we say higher highs means this place is higher than this place. So it's higher and high. All right, higher high. It has higher than this place. All right. Then the down here It's called lower low in an uptrend. All right. It's called higher low, sorry. Higher low in an uptrend. And what it means is that this place too is higher than this place, but is lower than this place. All right. So that is what it means basically. And my market always respect this structural flow. It's called structural flow. It moves higher high, higher low, higher high, higher low, higher highs, higher. That's how markets keep going. And what will you see when you're seeing? You'll be seeing candlesticks going like this, going like this, going like this, going like this, going like this. You'll be seeing the candlesticks going up, going up, going up, and forming these flows. All right. So in the same way in downtrend, you'll be seeing lower high is low but is high, and I'll be seeing lower low. All right, lower high and lower low. Market will just be going like this, like this, like this. Now listen to me. Anytime there is a break of this either higher low or lower low, we are saying there is a change in market direction or there is a change in market character. Market is supposed to move in structure, and the structure is supposed to be higher highs and higher lows. But anytime there is a break, we are predicting that there's an entire change of the trend. Now, a series of these higher highs, higher low, higher highs, higher low is what we call uptrend. A series of this lower high and lower low is what we call downtrend. Are you getting it? And a break of it is what we call change of character. All right. I think you when you get into the course, you get to know this more. All right. So this is just the concept of market structure. All right. And it's printed on your chart repeatedly. Let's go further so that I'll explain trend. All right. The market moves in waves and trend, which the candlesticks have printed over decades of market analysis. These waves is divided into three. All right. The waves is divided into three. We have the uptrend, the downtrend, and the sideways trend. All right. I think I explained this again more in the course, but let me give you a background knowledge of it. All right. So before you get into the course properly, so in an uptrend, this is what we have. We have three major markets in the forex market. We have the uptrend, the sideways market, and the downtrend. All right. So like I said to you earlier, because of structure, higher highs, higher lows. Are you getting it? But in the sideways market, you just be seeing equal highs and equal lows. All right, everything will be equal. Then on the downtrend, you'll be seeing lower lows and lower highs. All right, that is how it works. Please go back and read up. This is just a summary of technical analysis, and if you go read up your baby pips, you will understand all this concept. And as you are going into the course properly, you understand this concept properly. I will try as much as possible to go into the. Okay, let me give you